Hi, I'm Robin Roberts, President and CEO of Pikes Peak National Bank, and today I'm here to talk about the different types of business loans. At some point in the growth of any business, a business loan will be needed. Business or commercial lending is different than the loans of which most people are familiar, like mortgages and car loans. So it's helpful to understand how business loans are made and the types of business loans that are available. Business loans are made to the business entity, such as an S corporation or an LLC, and are guaranteed by the individual owners of that entity. Therefore, at the time of application, the bank will require financial information on the business and the individual owners. Can the bank make a loan only to the business entity without the guarantee of the owners? Yes, that's called a non-recourse loan. But those loans are the exception and not the rule. Banks do not generally sell their business or commercial loans, so the rate and terms of these loans are different than personal loans, especially residential mortgages. The terms of commercial loans tend to mirror the useful life of the assets that secure these loans. So real estate may be 20 years, tenant improvement may be 10 years, and equipment may be 5 to 7 years. In addition to the difference in terms, the rates are also different, usually tied to the prime rate, and depending on the interest rate environment, are fixed from 3 to 10 years. Of course, these are general guidelines and can change depending on the borrower, the bank, and the economy. So let's talk a little bit about the most common types of business loans. I would like to caveat this conversation by stating that I'm talking about conventional commercial loans and not loans that are guaranteed by a government agency. We cover those loans in a different video. I'm also providing general rates and term structures. Every bank and borrower is a little different. We'll start with commercial mortgages. These loans are made for the purpose of purchasing commercial real estate. The typical down payment requirement is 20%, but that could be increased for a specialty or single-use property such as a car wash or a domed building. These loans can be amortized over 20 years, and some banks will amortize to 25 years depending on the property. The rate will be fixed for a period of time, generally ranging from 5 to 10 years. At the end of that time period, the loan will renew at the rates available at that time and continue with the amortization. Next, we'll talk about commercial term loans. These loans are made to purchase equipment, purchase commercial vehicles, fund tenant improvements, and other business purposes. Usually, these loans are secured by the equipment or vehicles being purchased. Because these types of collateral depreciate faster than real estate, the terms of these loans are usually shorter, generally anywhere from 5 to 10 years. Additionally, these loans require a higher down payment, somewhere in the range of 30 to 40%. Finally, the rate may be slightly higher on these loans due to the type of collateral. A popular type of business loan is the commercial line of credit. These loans are made for the purpose of providing working capital to a business to fund gaps in their cash cycle. They are generally made for the term of 12 months and are either unsecured or collateralized with a lien on real estate or a UCC lien on equipment and business assets. Businesses draw on these lines of credit during periods of time when the business is awaiting payment, like government contracts and other receivables. Seasonal businesses use lines of credit to support business operations during the off-season. Lines of credit are expected to revolve in accordance with the cash cycle of the business and should not stay fully drawn for a 12-month period. Payments of interest are made monthly, and principal payments are made in accordance with the business cycle. At the end of the 12-month period, the bank reviews the use of the line and in most cases will renew the line for another 12 months. While there are many variations of business loans, these are the basic types. Like anything, all three types can be adjusted or changed to fit the different types of industries. New business owners are often surprised when they find out that they're required to provide annual financial statements and tax returns to the bank for the term of the loan. This is a significant variation from personal loans. However, banks are required to monitor the commercial loans in their portfolio, and that is done through the annual collection of financial information on the borrower and the guarantors. This is a natural aspect of commercial loans and should be expected. So how do you start the process if you need a loan for your business? The first point of contact is one of our commercial lenders. They'll schedule a phone visit or a visit to your business, and then you can discuss your funding needs. They'll describe the application process and provide you with a list of documentation that will be required. Finally, they'll set expectations for timelines and costs, then you can plan accordingly. We hope this video was helpful in explaining the different types of business loans, as well as some of the business lending processes. We look forward to meeting with you and helping you with your funding needs. Bank well, be well with Pikes Peak National Bank.